And welcome to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches and around Australia on the Community Radio Network. We also go out multimedia. We go out on Spotify, we go out on YouTube, iHeartRadio, and a whole range of different things. We also go out on the IFPA website where we help them with their continuous professional development program. So the lovely people at IFPA. And you'll note that our guest today is Stuart Sheary, who is also a subject matter expert with the Institute of Financial Professionals of Australia. Welcome, Stuart.
That's right. Thanks for having me on the show.
Wonderful. So, listeners, viewers, you will have noted that Stuart's been on the show before. We've talked about downsizer contributions and a whole range of other things around superannuation. And today's going to be no different. We're still talking about super because very topical. We're coming up to around tax time. And Stuart, you reached out to me and said, Ray, we really need to do a show about some of the things that people end up doing incorrectly. Gee, that would never happen, would it, with taxes? So I thought it'd be a good education piece that we would cover off some of the common things that people aren't getting right when it comes to super. So, ladies and gents, Stuart sent me this interesting paper, which we will probably put a link in our blog and refer to it. But I guess, Stuart, what are some of the common catches that people are getting wrong when it comes to super?
Well, a lot of them come down to what we call concessional contributions. So particularly in the area of making a personal deductible super contribution, they might be contributing too much, or they may not be eligible to claim the deduction because they haven't done the necessary paperwork. So just as way of background there, when we're talking about concessional contributions to super, we're generally talking about contributions for which someone is entitled to a tax deduction. So for example, we have super guarantee being your compulsory employer super contributions. They're a form of concessional contribution. We have and of course, your employer there would be getting the deduction in that instance. We have salary sacrifice contributions. So again, that's where your employer will make a contribution on your behalf in lieu of your salary. And by virtue of receiving less income, you pay less tax. And then we have what we call personal deductible contributions. That's where you make a personal contribution and claim a tax deduction. All those contributions count towards what we call the concessional contribution cap, which is generally around $30,000. And what we're finding is when it comes to personal deductible contributions, people are making common errors.
Okay, so when we're talking about this concessional contribution cap around 30K, it's 27.5, isn't it? It's going up to 30 or something like that?
It's currently $30,000. So last year was $27,500. This year it's $30,000, and next year it will be $30,000 as well.
Okay, but when we're thinking about super and the current SG rate is 11%, I think, 11 or 11.5.
11.5%, and it will go up to 12% from 1 July. Yeah.
So if we think of that, ladies and gentlemen, in pure dollar figures, to hit that cap, you've got to be earning roughly about, what, 275,000?
I think that's around, you're pretty close to the mark there. I have to check, but I think you're pretty close to the mark. Yeah.
Very rough mathematics. But so for people that are earning less than $275,000 a year, you won't hit that cap unless you make some additional voluntary contributions. Isn't that correct?
That's right. So if you're on a income, if your super guarantee isn't taking you to the full $30,000, which would be the case if your income is below a certain threshold that you mentioned, you'd have space to make a concessional contribution either by salary sacrifice or personal deductible contributions. And we don't want to go over that concessional contribution cap.
So I guess when we think about the average wage, and I the old story of lies, damn lies, and statistics comes to bear again, because when you think about the average wage, and I like to refer more commonly to the mean wage, and I'm not talking about mean as in mean and nasty, but mean as in, where does the vast majority of the salaries squeeze in? And it's not roughly 60,000, which is the average wage. The mean wage is closer to 100,000, isn't it?
Oh, good question. I think the Australian Bureau of Statistics, they came up with a figure pretty close to that, around $100,000.
These are just rough back of envelope kind of numbers. But the reason, ladies and gents, I make reference to this is because whilst people are saying the average wage is 60,000. When you think about the very top earners, that sort of skews that number, because there's a lot of people not making a lot of money at all, because a lot of people are underemployed as well. And this is one of the things that, it's not just the current government, but it's been something that's been going for a long, long time. The underreporting of underwork tends to hide a real underutilization of the available labour force that's out there. And look, it's a discussion point for another time, and it's policy or whatever. But when we're talking about superannuation contributions and the like, I like to talk about the numbers because it's important that people understand who this impacts. And, Stuart, we're going to be doing a follow-up show on Div 296, which talks about a $3 million cap. And yet, there's so much activity around this discussion at the moment, but it affects not a lot of people. And so I think there's a lot of hyperbole in that there. And what I'm trying to do with the education is just sort of calm the rhetoric down a little bit and get a little bit of common sense into the discussion and say, okay, let's look at the harsh numbers. And so when we're talking about, are people generally going to get it wrong when they're looking at their taxation around super at the end of the year? I think it's a real pertinent question, don't you think?
Absolutely. And that gives rise to the question, the value of advice, basically. So in the context of making personal deductible super contributions, because we're approaching 30 June, a lot of people out there are thinking, well, okay, I've made charitable donations. What else can I do to reduce my tax? And making a personal contribution into super before 30 June and claiming a tax deduction on that contribution might be a good way to save for retirement and also reduce your tax bill for this financial year. But just keep in mind, we don't want to leave it too late. So one problem we sometimes come across is people making contributions on the 30th of June. And I think that's okay. The money left my bank account on the 30th of June. But if the super fund doesn't receive it until the 1st of July, unfortunately, you're not going to be able to claim a tax deduction for that contribution in the current financial year. You'd have to claim it in the next financial year. So it's when the super fund receives that money that's important. So don't leave that contribution too late.
Yeah, I think you make a very valid point, because even in the modern day of internet banking, people assume, wrong, ass out of you and me when you break the word assume up, and it still does. Just because you send the money off doesn't mean it lands in a timely manner. And I think it's really important, ladies and gents, that you understand the contribution is not deemed to have been made until it's actually received. And Stuart, you make a very valid point. And so just because you've sent it doesn't mean it's actually been processed. And I know because I have payroll, I pay my contractors and my staff with my own company. I know I get notification from superannuation companies saying, hey, don't forget, send in your money a couple of weeks beforehand, because they've got to process it as well. And so it's not just about landing, it's also about being processed. That's correct, isn't it too, Stuart?
Absolutely. And you raise a great point there. Think about also when we're looking at our concessional contribution cap, were there any contributions that maybe landed, that should have landed last financial year, that landed in this financial year? We need to take those contributions into account.
So you've got to go and look back at, maybe a month beforehand and see, okay, there was a contribution that went in, let's say on the 30th of June. When did it actually land and get processed? Because it may actually fall into this current financial year and you can get the tax deduction on that. But it may have also blown you out past your concessional cap. And so therefore you could be then subject to more tax. And so it's a funny thing. They talk about market timing. It's also, it's about processing of invoices and money when it lands and comes in. Same thing applies to super. There is a very firm cutoff date, isn't there?
Absolutely, yeah. And there's a great resource. It's called MyGov. If you go onto MyGov tax, look under the super section, they can give you a history of super contributions made. So that can assist you if you're thinking about making a end of financial year contribution into super.
I think, Stuart, you raised a valid point. I'd like to talk a little bit about the MyGov website. I've got 3 adult kids that are still living with me, and so I'll help them do their end of year taxes. And I can remember I've still got, I don't know why, I've just I was an army apprentice and I still have my tax returns from 1976. And I do it just to show the kids and say, hey, look how much money I made back in 1976. But I think that the interesting point that I'm trying to make is that the wealth of information that is now available through MyGov, and so pre-filling, there's a lot of pre-fill being done, and with single touch payroll now, which a lot of the accounting packages out there, MYOB, Xero, Quicken, Intuit, all these different packages, ladies and gents, they're feeding information and data into the ATO automatically. And so one of the other things I think around tax time, it used to be sport, I think, wasn't it? You know, how can we diddle the tax office? It ain't quite so easy these days, is it?
Yes, the ATO have a visibility of a lot of things that they didn't have visibility of in the past. So yes, absolutely, you're right.
Data matching, I think, is the lovely
Data matching
term
is
that
the word. Yes,
they use data matching. And so I was showing the kids, you know, when I can remember when I got a little bit more money in and I was doing these tax returns, it was just one of those efforts and shoe boxes of receipts and all that kind of palaver. And given the fact that, you know, gosh, I think the longest time I spent doing one of my kids' tax returns would have been maybe 10 minutes, if that, because you draw it down out of MyGov, it's all filled. All you've got to do is, like you say, you've got to
be careful that you don't put your own data in there, because it's doubling up.
It is. And again, it was one of those fascinating times. I found out the generosity of one of my kids who loves giving to activist organizations like the WWF and a few other things. It was like, wow, that's really cool, you know. I thought, and she said, my daughter said, but I can claim that. I went, oh, absolutely. I was just surprised. I didn't know anybody actually did that. You know, I still think the biggest charity is my home right now. So I'm still trying to contribute to this at the moment. And so charitable contributions is quite valid. But I think it's, you know, when you mention about cost of living and your ability to reduce your tax, super is a really good one, isn't it?
Absolutely. Yes. Superannuation is still one of the most tax effective environments there is out there. So, and a good way to do that is, of course, making additional contributions to super, either by way of salary sacrifice or personal deductible contributions. But again, with personal deductible contributions, there's some legislative requirements there. There's some paperwork that we need to complete. So make sure that gets done. So for example, if I were to make a contribution into super today, and I want to claim a tax deduction for it, I'll need to submit what we call a notice of intent to claim a tax deduction. It's a form. We need to provide the super fund with that form before the earlier of me submitting my tax return for the current financial year and before 30 June of the subsequent financial year, i.e. 30 June 2026. I have to submit that form to the super fund, and they need to provide acknowledgement before those timeframes. And of course, if I make a withdrawal or there's a rollover, I'd need to get the form in before those deadlines too.
Right. Okay. Well, we're just about half time. You're here on Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson. I'm really pleased to have at the microphone Stuart Sherry, who is a subject matter expert on superannuation from the Institute of Financial Professionals. We're going to take a short break, and we'll be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm really pleased to have at the microphone this week Stuart Sherry, who is a subject matter expert on superannuation. He's from the Institute of Financial Professionals of Australia. Now, Stuart, before we went to the break, we've been talking about some of the common mistakes people might make when doing their tax returns around end of tax year, which we're at right now, getting close. And so around superannuation, one of the things I wanted to quickly ask before we move on to some of the other topics in today's discussion is about spouse contributions as well. So if people are looking for a tax deduction, and I know many couples are looking to try and balance their spouse's super balance because, childbirth or, people out of workforces at various times. What's the story there?
Yeah, so where there's a lower income earning spouse, it is possible to make effectively a non-concessional contribution into their super fund, and the contributing spouse can claim a tax offset in their tax return. So it's not a tax deduction. It's in a way better. A tax offset reduces your tax dollar for dollar of up to $540. So if a spouse makes a spouse contribution of $3,000, and depending on the spouse's income, they may be eligible for a tax offset of up to $540.
Okay, and there's also a way to also split the contributions, which I actually have nominated in my own super fund in the last financial year, because again, we've got an imbalance. And so what's the story on that? What can people do to nominate that?
Yeah, so with contribution splitting, the context there is we're effectively rolling over last year's concessional contributions, or last financial year's worth of concessional contributions, or more specifically 85% of last year's concessional contributions, because we can't roll over the tax bill that came with that concessional contribution. So we can roll that across in the new financial year to our spouse. We just need to speak to our super fund and provide them with the relevant form. There are limits on how much we can roll over, that being limited to 85% of last year's concessional contributions up to the concessional contribution cap.
Cool. Okay. So again, these are all strategies that I know your advisors would be talking to you, ladies and gents. So if you are a couple out there and you need to start balancing up, this is a great way of doing it. Now, one of the other things that we've got on our list of things to talk about is a work test exemption. Now, I thought the work test rules had sort of gone by the by, but there is something there that we still need to consider. Can you explain it a little bit?
The work test is still kind of lingering there. So in the past, you had to satisfy the work test to make a personal contribution if you are between ages 67 and 75. Now, after 75, or rather the 28th day of the month following your 75th birthday, you can't make personal contributions regardless of the work test. Okay. You still can't make personal contributions after 75, but you can make personal contributions if you are between 67 and 75 and have not met the work test. So they've scrapped the work test in the context as your eligibility to make contributions, personal contributions between 67 and 75. But if you want to claim a tax deduction on that personal contribution, you will need to satisfy a work test if you are between 67 and 75 at the time of making that contribution. And that work test basically says is you've worked 40 hours over 30 consecutive days during the financial year. Might be before you made the contribution, might be after the contribution, but sometime in that financial year, you have worked 40 hours over 30 consecutive days.
Now, one of the interesting things, and this is applying to retirees or semi-retirees that are trying to boost their super, some examples of the working in part-time jobs: dog sitting, exam facilitator, coach for a sport team, or a lollipop person. So I really like that, because I remember my days at P&C, we always had lovely elderly lollipop people, and they were doing it to be able to meet this work test issue. So that's always something to remember. Now, another one on your list here is claiming too much as a tax deduction. Is that possible?
Great point. It is very possible. So first of all, the ATO will not let you claim a deduction for more than your taxable income. So if I had $20,000 of taxable income, I can't claim a tax deduction for $30,000 and put myself into a loss position. The ATO won't let that. But we can go further than that. It just doesn't make sense to bring your taxable income below what we call your tax-free threshold. So we all know about the tax-free threshold of $18,200. We definitely don't want to be bringing out taxable income below that point, because what's the point? The concessional contribution is subject to 15% tax. but I'm not paying any tax anyway in my own personal name. So we may as well make what we call a non-concessional contribution into super. But the tax-free threshold is actually a little bit higher than $18,200 because a lot of people will have what we call tax offsets, such as the low income tax offset. So for a single person, if you take into account the low income tax offset, their tax-free threshold is effectively $22,500 thereabouts. So it doesn't make sense to bring your taxable income below $22,500 in that scenario.
It's sometimes referred to the listo or something like that. I've heard that term before.
Low income superannuation tax offset. The listo is a separate offset that more relates to low income earners. Their super contributions will not be subject to 15% tax if their income is low and it's between particular thresholds.
But the government will chuck in. But the government will chuck in some money to low income earners to top their super up to hopefully, do some good things. But there are offsets, like you rightly say, that lift that 18,200 a little bit higher. So it's always worth trying to push that, couple of $1,000s more, because you will actually get your tax back on that money, won't you?
Yes. If your income is low and you make concessional contributions, the government will pay that, if you like, 15% tax back to your super fund account. That's to be separated. Sometimes we get that confused with the government co-contribution, where you make a $1,000 contribution into super and the government will top that up with an additional $500. That's what we call the government co-contribution. And also what you're referring to there, the low-income superannuation tax offset, sometimes that's referred to the government kind of co-contribution as well. So it can get quite confusing.
Okay, so moving on, we've got another ability to do super contributions via an in specie contributions. That's kind of a Latin terminology. What does that actually mean, Stuart?
Well, in specie contributions typically only relate to people with self-managed super funds. It can also relate to people with what we call wrap accounts that have with a basket of shares. But what we're talking about there is where we're not making a cash contribution into super. Instead, we're transferring perhaps off-market listed shares or assets that can be acquired by the superannuation fund. So typically only dealt with inside of self-managed super funds. And that's where perhaps, we want to hang on to an asset, but we don't want to own it, but we'd rather the super fund own it. And we're going to transfer that asset into the super fund, such as listed shares, and have the superannuation fund own it instead.
Okay, this is probably going to be something that we're going to talk about in another show, but this is where, for example, collectibles, in instances, real estate, does that come into in specie as well?
Yeah, I'm glad you raised that. There are restrictions on the assets that a self-managed super fund can acquire from a member. And so basically the rule is a self-managed super fund cannot acquire assets from a member unless an exception applies. Those exceptions include listed shares, business real property, and widely held units in a unit trust.
So again, a unit trust is equivalent to a managed fund, or it's something that's ASIC regulated, but it's not just a willy-nilly bunch of whatevers. It's not a painting, for example. It's actually something that's regulated. They run an AFSL.
The rules will not allow the super fund to acquire or receive a contribution by way of artwork. No.
Yeah, we're going to have an interesting discussion next time around on real estate as well, because it's quite topical at the moment, isn't it? But look, again, I'm interested in some of the terminology, wash sale and market value. We're just running short of time, but very quickly, can you explain those?
Yeah, just make sure if we are making a contribution into super, it is at market value. So wash sale is a scenario where someone disposes of an asset to realize the capital gain and quickly buys it back. So there's no real change in ownership, if you like, almost. So if we put that into the context of a self-managed super fund, if we were to deliberately transfer assets by way of contribution into the super fund, say listed shares, realize a capital loss for the sole purpose of using those losses to offset other gains, there could be a case of what we call wash sales, whereby we haven't really we've kept our position, if you like, in an asset, but we've just done that to realize a capital loss.
Yes, the tax office looks dimly on those kind of activities, I guess. So, look, Stuart, we're just about out of time. Fascinating discussion. And again, ladies and gents, IFPA is an organisation filled with lots and lots of tax agents. There's sort of that tier just below the CPA and CA organisations, and there's a lot of very good organisations that are IFPA members. I've met a bunch of them at the conferences and the like, and I guess for the everyday taxpayer that have got reasonably straightforward set of requirements, your members, I think, are excellent people that would be out there serving those needs. So, Stuart Sheary from IFPA, thanks so kindly for being part of Dollars and Making Sense today.
Thank you, Ray. Speak soon.
No worries. And adios.